Asymmetrical risk, for people that don't know, is relatively low risk for high return.
How are they finding good deals? And are there themes? Like, are there specific areas where you're like, if you play in this space, you'll probably have an easier time finding investors than this one?
Number one, either you could find those deals, and maybe you're in a certain industry, you increase the surface area of the luck by being just exposed to an industry and being there. You will see more opportunities for growth or potential. The second way is it's not how, it's the who. Go find someone who is in that space. I call them broke geniuses. There are lots of broke geniuses, people that sit in their basement and trade options every day, and they do extremely well, but they have no clue on how to launch a fund, how to raise capital, and do all the other stuff around that. Especially with smaller funds, I'm gonna say less than $15 million, there is a lot of opportunity for asymmetrical risk.
Hello, welcome back to Mission Daily. This is your host, Stephanie Postles. And I'm wondering, have you ever had the thought, should I start an investment fund? Or what are the risks with private equity deals? Or should I just write an angel check into this awesome new company that I just heard about 5 minutes ago? If you've had any of those questions, then you're in luck, because today I've invited on Bridger Pennington to join the show to answer all of them. Bridger started his first fund when he was 22 years old. Since then, he has helped over 300 people launch their funds that now has a combined assets under management value of over $2.7 billion. He's the founder of Fund Launch and AltStreet, and joins us to dive into the risks, the benefits, the logistics, all things investing. Bridger, welcome to the show.
Well, Stephanie, thanks for the intro, and good being here. I'm excited to talk. Let's dive in.
I'm really excited. I feel like I have so many questions today, and with our limited time, I'm like, I hope I can get through all of them. But to start, I think to answer probably a lot of listeners' questions, the first one is I want to go through the basics. Like a lot of people I saw searching for, what is a fund? How does it work? And so I know this is very 101 for you, but I would love to just, start the groundwork there of like, what is a fund? How does it work?
Yeah, that's great. What is a fund? In my vernacular, a fund, all it is a pool of money. Investors are going to put money into that pool, and then fund managers like me and you are going to go draw from that pool and go make investments. And whenever those investments make money, it flows back to the pool of money, and we just split the returns. So this is like one of the oldest business models on earth. It was like 1,000 years ago, me and Stephanie were going to open up a blacksmith shop. Hey, we need some money to open up this blacksmith shop. Whenever we make returns, we'll just split the returns with you guys. Like that's essentially the business model. Now, people have put these terms like, so what is private equity, or what is venture capital, or hedge funds, or real estate funds, or debt funds, or private credit? Funny enough, we've helped all these people launch all those funds multiple times. The crazy thing is they all run almost exactly the same with small nuances. And this is the thing I hate about the world of finance or finance, if you're really proper, is they try to make simple things really technical so that they sound really smart. They're actually not that crazy. So let me just give you a brief example. So what's the difference then of a real estate fund or a private equity or a hedge fund? Like, what are the differences? Well, all of them, again, are a pool of money. The differences are what they invest into. So for example, a real estate fund is a pool of money, and they go buy real estate. They go buy apartment complexes, duplexes, fourplexes. That's what a real estate fund is. A private equity fund is a pool of money. Instead of buying real estate, they go and buy private equity or private ownership of businesses. A good example is Sycamore Partners on Wall Street. They manage about $10 billion. And I'm guessing most people have never heard of Sycamore Partners, but they own Staples department store, Nine West Shoes, Aeropostale. They were trying to buy Kohl's department store last year. They were trying to buy Victoria's Secret 2 years ago. That's a private equity firm. We have a lot of people in our group doing micro private equity. They're going and buying up restaurants and other smaller, so you're buying privately held businesses. So what's a hedge fund? A hedge fund is a pool of money. Instead of buying real estate or private businesses, they buy public businesses or public securities. So they'll buy stocks, bonds, options. They do Forex, crypto, anything in the public markets. That'd be a hedge fund. So they all actually function and run very similarly. There's a few nuances on each one, but that's the basics. It's actually not that complex. It's not that crazy. And this is the whole purpose of these things, though, is to go and just play bigger, is to do, instead of buying one duplex with a fund, you could go buy 30 duplexes and pool them all together into one pool.
So you started your first fund at 22. Where was that driving interest where did that come from?
Yeah, I'll tell you a little bit of my story, and you can pick it apart, and we'll go fast. But I grew up in Salt Lake City, Utah, not a finance hub. I grew up in a very normal household. I started a 2-year church mission in Taiwan. I went to college. I was very ambitious. I started 6 businesses my first 2 years of college. And I was hungry, I was ambitious, like I gotta make money. So I actually wholesaled 2 houses. I did a website building company. I did a Chinese tutoring business. I mean, these were like random businesses. Finally, my dad grabs me. He goes, Bridger, you're kind of like a chicken with your head cut off. I want you to go meet with this business partner. I think this guy can really help you out. And again, my dad drove a car with a dent in the door, 300,000 miles on it. Like we were fine, nothing wrong, but nothing that fancy. I drive to my dad's business partner's house. I pull up and he lives in this gorgeous, beautiful mansion. It like encompasses like a cul-de-sac. I'm like, who the crap is my dad's business partner? This guy's incredible. So I park my car, I go knock on the door. I'm all nervous. And a guy comes to the door. I'm worried like they're gonna kick me out. Like, get out of here, peasant. Like you're not welcome. Anyways, thankfully my dad's business partner answered the door. He goes, Bridger, come on in. He welcomes me in this house, and it's beautiful. I mean, he's got wine cellar, basketball court in the basement, pool in the backyard, cars, the whole thing. We sit down, and to make a long story short, I started to ask him about his career, his business, and what did he do? And he goes, Bridger, I was a lot like you in my 20s. I started multiple businesses. I did extremely well. But he goes, then I met a guy who ran a private equity fund. Relatively young guy. He was one of the wealthiest, most successful people I'd ever met. And he goes, I didn't even know what the words private equity meant. And now people that's listening, you guys know what it means now, but he's like, I didn't even know what it meant. But he goes, I set a goal from that moment forth, like I was gonna figure out what this was, what private equity was, and how to get involved or how to start one or how to go and do this. He goes, that's what we did. And at the time, he goes, we're managing roughly $8 billion of real estate right now in real estate private equity. And I was like, whoa, that's a lot. And that's, to put that in perspective, that's 2 times bigger than Cardone Capital is today. That's how much money they're managing. Today, now they're 10 times bigger than Cardone Capital. As a same it's real estate, multifamily assets. So I was blown away. I was like, hey, can I learn more? How do I do this? Can you mentor me? I've heard podcasts tell me to find a mentor, go find a mentor. I was like, I'll bring you coffee, like whatever you need, dude, I'll be your guy. And he goes, Bridger, go talk to your dad. Your dad knows way more about this than I do. And I said, no, my dad's kind of broke. We live in a small house. I want to learn from you. Like, that would be awesome. And so he goes, sorry to break it to you, Bridger, but me and your dad make about the same amount of money. And my chin dropped to the floor. I was like, huh? He's like, yeah, me and your dad we're pretty much equal business partners in this thing. And I left the dude's house. I drove straight to my dad's house. I was like, Dad, what the heck? Like, what's going on? Like, why haven't I been able to order a drink at Chipotle for the past 10 years? Because it's too expensive for the family. And yet you're managing billions of dollars of like real estate. Like, what's going on? And anyways, to make a long story short, my dad's like, yes, that's what we do. And he then started to teach me about funds. I'd go to his house every Sunday night, and he would get a whiteboard out and started to teach me about how funds work, how they raised capital, how they ran their business, all the stuff in funds. And funny thing, what happens when you start to learn about something, you start to be attentive to that thing in your life. It's like if you buy a new car, you're attentive now to that new car, other people that drive that car, right? So I was very attentive to funds and fund opportunities. I was in school at the time. I was running another business. I was working an internship at a job. At that internship, it was kind of a startup company. I was interning and working for them. We had an idea to start a fund inside of that business. And the fund would do financing. They would do loans to some of the clients that were coming through this business. And I thought it was a really cool idea. I took it to my dad. I took it to the founders of the company. They liked the idea. My dad loved the idea. We started to put together the fund docs, all the kind of stuff there. I'm 22 years old. I was really excited. I go and I'm going to launch my fund. This is going to be amazing. And I'm like, crap, how am I going to raise money? Who's going to put money into my fund? I'm in college. I have no track record. Who would invest with me? No one, right? But then I said, oh, well, duh, my dad. And maybe his business partner, they like me, right? They've helped me. I'll go pitch my dad for money. And so it was a late Sunday night. I went and watched my dad's home office, and I pitched my dad. I said, Dad, how would you like to be our first investor into our fund? And my dad kind of smiled and laughed and said, Bridger, I have the money to invest, but if I invest in your fund, it would ruin the experience of you going out and raising money on your own. This will be a crutch that you'll never be able to recover from. Your first investor is your hardest investor to find. And he said no.
It's good parenting right there. Good job, Dad.
Good. There's a lot of lessons that you can probably unpack there, which is great. And kind of kicked me out and said, you got to go do this on your own. So I went out, I hit the streets. I talked to everybody I knew. I raised a whopping $49,500 from a handful of investors. It took me about 3 weeks. Now that's teeny. In the world of funds, that's like micro, but it was enough for us to get started. We were doing these micro loans for financing. The loans only took 30 to 60 days to come back. So we turned that money. Our first group of investors, we got them a 64% rate of return, which was phenomenal. So small amount of money, but good return. We then launched a second fund. That fund did extremely well. We raised and deployed millions of dollars out of that fund. Ran that for about 3.5 years. We had a competitor come and buy us, gave us an offer. We exited and sold that company, and it did extremely well. And then since then, I've launched another fund in the blockchain space. We've raised and deployed tens of millions of dollars in that fund. And then we just launched a GP stakes fund. We're raising $100 million for that fund. It's been phenomenal. To this date, my dad has still never invested in a single fund or deal I've done. But he's been a great mentor and coach for me and been phenomenal. But doesn't own any of my businesses, has not invested in any of the businesses, anything like that. And then through that process, we started a company called Fund Launch. So we had a lot of people asking myself, my dad, my brother is also an investment funds attorney. So he's an attorney for funds and fund managers. He worked at the largest law firm in the world for funds. So we started to make content online. We made YouTube videos, a podcast. We made a small course. We made a bigger course. As of today, we've had over 100,000 people take one of our courses online, which is crazy to me. Like that's just bonkers numbers. We've now had over 300 funds that have gone through. We have a full process we built out. Like we brought in now coaches. We do live events. We've built a pretty cool business with Fund Launch, and it's been phenomenal to see these funds come through and do incredible things. I run 2 funds now, and then we've had now hundreds of people come through and launch their very own funds and raise in aggregate billions of dollars for their deals and funds. It's been phenomenal to be a part of and a really cool thing. And that's where we're still going.
So when thinking about starting a fund, I watched some videos of yours in the past. And what I found interesting was that I feel like you take the model and you flip it outside what most people probably think. Like most people coming into a fund, they think, okay, I need to set up my legal asset. And then I need to pick my companies that I really want and then go find the investors and pitch them hard. And that's the process most people would think. And when I've watched your content, you're like, wait, don't start the legal stuff. Like actually go and find the right way to pitch it and do these soft pitches so you don't ruin your investor pool. And the way you talk about it feels so much more grounded and reasonable to get started. And so I'd love for you to talk about like, if someone were thinking about starting a fund today, what are some of those first steps, especially if they don't have a finance background, like they don't know this space?
Stephanie, you framed that out very well for me. So yes, I totally agree. If you hire lawyers are fine. You can go hire a lawyer. A lot of people think I'm going to go start a fund. Step 1, go hire a lawyer, which is fine. But lawyers, a couple of things. They're going to charge you $1,000, $1,200 an hour. They're going to talk slow. They're going to be methodical about all the stuff, which is fine. I had a friend spend roughly $400,000 with lawyers on his first fund. Not because it cost that much, it's because he didn't know what he was doing. And so a lawyer, he paid a lawyer to teach him about funds. Lawyers are not good capital raisers. They're good at being lawyers. And so what happened is when he went to raise capital, he kept changing and iterating and kind of refining to make a better product. Every time he refined it, his lawyer said, yeah, we can tweak that in the docs, and they billed him by the hour. He spent $400,000 on legal docs for a fund that maybe should have cost him $30,000 to set up. It's because he did the whole thing backwards. So we've coined a term called the fund launch formula. This came from after me interviewing hundreds of fund managers and working with fund managers. And we found this an amazing process to launch funds. This is how most people actually go out and launch their funds. So of the 4-step formula, step 4 is legal. It's actually last is your legal process. Step 1, what I tell people is number 1 is come in, get extremely educated on funds. Know what you want or don't want. You're going to have to understand it anyways. The lawyer's going to teach you or somebody else can teach you. So come and get extremely educated on what funds are, how they're built. Additionally, let's look at what we call the deal phase. So step 1 is find a great deal or strategy, and we're going to find asymmetrical risk. We're going to build a team around that strategy, how we're actually going to execute on the strategy. Part 2, so step 1 is find a great deal. Step 2 is frame the fund out. So we're going to go through and frame what licenses you need, how you're going to structure your waterfall. Are you going to do a registered investment advisor, all the intricacies of your fund? Are you going to raise international investors or just domestic investors? Again, a lot of the education will help you with that on that phase. Then once we've framed out the fund, we've framed out a great deal, we drive that down to usually a pitch deck. And that takes us to step 3, which is go and actually pitch investors. People go, wait, hold on, Bridger, I don't have legal docs done. How do I pitch investors without legal docs? And I go, well, you go and soft pitch or float this around to potential investors. See if it's interesting to them. See if they would actually write a check if you went and set this fund up. More often than not, you're going to tweak and change and iterate your product, your fund. Think of your fund as a product. It's an investment product. And you're going to go back. So that's step 3 is, so step 1 is find a great deal. Step 2 is frame the deal out. Step 3 is raise capital. You're probably going to go back to step 2 or step 1 and kind of tweak and iterate this fund. Our goal for everyone that comes through our process, we try to get them around $2 million of verbal commitments. Meaning people say, yeah, this is interesting. I would put down $100,000 or $200,000 if this was actually a fund. Once we achieve that, then we go to step 4. We hire a great lawyer, and you walk and you go, hey, I know exactly what I want. I want XYZ with a drink and a side of fries. Like boom, bada bing. And they go build the fund for you, and it's launched. You go get all those investors in, and your fund is up and running. Most funds never launch. Most funds never launch, I'll say, with the original strategy they started with. Most funds come through and iterate, and you got to think of it like a product. And so that's what we help people think through is this product of a fund. So if you're sitting there like, I'm thinking about doing a fund, great. What I would tell you, get educated. Let's start thinking through what your fund would be. Let's go float it to investors and see if we can get real world validation. Then if we have validation and we have people that will actually write checks, people that are actually going to invest in this thing, then we'll go get a lawyer. Let's draft the documents. Let's put it together and you can go launch your fund. Hopefully that makes a little bit of sense, Stephanie. I'll let you jump in.
Yeah. No, I mean, this makes a ton of sense. And I will say that I have a background in finance. And I actually think if you have a background in finance, it's probably more limiting because that's more, operational. Things have to be a certain way. Whereas this model feels much more entrepreneurial. It feels like we're finding product market fit here through funds. And that's what every entrepreneur is doing in the beginning. Like normally you're like, no, I don't have a design. I don't have a logo. I don't have brand colors. I don't need any of that yet. I'm more just trying to see like, is this something the market wants? And if not, let me keep iterating before I launch my whole brand, before anything else. So it feels very similar, which is why I really appreciate this model.
It is. Yeah, it's a great, you find validation. And I'll share the same thing. It's funny with different businesses, we can probably talk about this, but people think, I'm gonna use a different example. People think just because they have a website that millions of dollars are just gonna magically come to them.
Yeah.
Way more important than logos and colors is the actual product and how the messaging around that product. And do we have validation on that product, right? Same thing's true with funds. People forget these lessons when they go launch a fund. They just believe, oh, I hired a lawyer. I have legal docs. Magically, millions of dollars are going to flow to me when they haven't built a great investment product. And so how do we validate and build a great product? And then we can figure out all the other stuff later. Let's build a great product first. So that's what we push people to do. And it's been a pretty fun result so far.
Yeah. So one thing that came to mind, I'm sure a lot of people, when they're hearing the different 4 steps, and especially if they listen to, I just had Oren Klaff on the show. And so it was a little bit different of an angle of like, you're going to have a hard time finding good deals. There's so many big players out there. I was a little more pessimistic when it came to spotting good deals. And so I'd love to hear from you, especially because you have insights into probably, all these funds, different portfolio companies that they're investing in, or, private equity, whatever it is that they're investing in. You have a lot of insight into this. How are they finding good deals? And are there themes? Like, are there specific areas where you're like, if you play in this space, you'll probably have an easier time finding investors than this one?
Yeah, great. And Oren's, we just did an event with Oren 2 months ago at his place. We've done a lot of content together, me and Oren. So,
okay, then you know his personality.
Yeah, he's fun. So on that note, what I tell people on the deal side, where do I find good deals? Number one, either you could find those deals, right? And maybe you're in a certain industry, you increase the surface area of luck by being just exposed to an industry and being there. You will see more opportunities for growth or potential. The second way is it's not how, it's the who. Go find someone who is in that space, who has ran, restaurants for the last 20 years. I call them broke geniuses. There are lots of broke geniuses, people that sit in their basement and trade, options every day, but they do extremely well, but they have no clue on how to launch a fund, how to raise capital, and do all the other stuff around that. Mm-hmm. Especially with smaller funds, I'm going to say less than $15 million, there is a lot of opportunity for asymmetrical risk. For example, I'll just share a few things. We've had guys right now in California buying up almond farm funds. They find almonds and cashews have way more margin and because they're high end, they can sell them to these high end brands. They buy up different farms, they group them together, they have great multiples on those. We have other guys buying car washes right now. They buy like Wiggy washes and Quick Quack car washes and stuff like that. When they buy them by themselves, they trade at like a 2 to 3x multiple. Once they group together over 30 of them, they trade at a 15 plus multiple. Because you can centralize marketing, centralize finance, all the kind of stuff there. We have other guys doing dental roll-ups. They're buying up dental practices and rolling them together. We have other guys in California buying up scripts. So there's all these writers in Hollywood that write these mini series and TV series and stuff that are broke. They will go buy a script for $20,000 or $30,000 from a broke writer. They turn around and sell it to HBO, Netflix, Amazon Prime for $200,000, $300,000. That's all they do. So there's a lot of these little niches that people have found that do extremely well. Now, there's plenty of people in our group as well doing house flips, doing duplexes, just because of how vast real estate is and how big players usually move into bigger deals. At the smaller end, there's a lot of interesting things you can do in real estate if you're a good operator and you've done well and you have the ability to scale with a fund. Having a fund gets you lower interest rates. You can close faster on deals. You can win more deals. I could go on, but at least every day I see people with really great deals, asymmetrical risk that need to scale.
So when you say asymmetrical risk, are you thinking to make it asymmetrical, you already have some kind of upside in that industry? You already have subject matter expertise. You already have Hollywood partnerships. You already know a lot about cashews. Like, is that how you get the risk? Is more by like outworking or out having a better network or something like that? That's
one example. And asymmetrical risk, for people that don't know, is relatively low risk for high return. It's the delta between. That's what fund managers search for, is they call it alpha or asymmetrical risk. Expertise is one way to find asymmetrical risk. There's other ways. Deal flow, proprietary deal flow is massive. Just the way you structure. I was with Ray Dalio last year and he goes, we can diversify away about 80% of our risk without losing any of our return. So just by the nature of how you structure your portfolio, and that's what he mentioned, he always talked about finding 10 to 15 uncorrelated assets and putting them together in a portfolio de-risks your investment by up to 80%. So the way you structure your deal or structure your fund on the assets you are purchasing, you can also find asymmetrical risk in that sense. So a lot of different ways to find that same result.
Okay, got it. That makes sense.
The one example I would give to people though, if that's still, because people always, you probably heard high risk, high reward, low risk, low reward. And there's a theory called the efficient market theory, that all markets are perfectly efficient, which may be true with public markets, and it's getting more with AI and augmented trading. Maybe it's becoming more efficient market theory, things that are not, everything's priced into the market already. But with smaller things, this is why on a statistical level, smaller emerging fund managers actually outperform larger funds by returns. It's just, there's way more alpha to be had when you're running a $20 to $30 million fund versus a $20 to $30 billion fund. You can find just smaller niches. So I'll give people an example. Let's say me and Stephanie were starting a business together and everyone was underwriting our business. And let's say we have a medium level of risk and medium level of return, right? So medium risk, medium return, great. And you guys are looking to invest in our fund. But then me and Stephanie announced, hey, we have a new business partner in our firm. We just announced we're adding Elon Musk and Jeff Bezos as business partners. Is the chance of return go higher or lower with those two partners?
Hopefully
probably
higher.
Way higher, right? Like the chances of going up is like, whoo, it's like through the roof. So return goes up. Okay, what about the risk level? Is it more risky or less risky?
Should be less.
You could argue.
Well, they might take more risk, actually, Elon.
Yeah, Elon's kind of a risky character, but still, they've got hundreds of billions of dollars. Like they've succeeded in pretty much every business they've ever started. I would probably take that bet over somebody else, right? So let's say risk stays the same, or maybe it goes down or maybe up a little bit, but the return goes massively higher. So by me and Stephanie just introducing one or two business partners, we've created asymmetrical risk. We've created way more return for the same amount of risk, roughly. Especially in private markets, there's a lot of opportunity for asymmetrical risk. The reason house flippers have a job is because of asymmetrical risk. Someone walks into a house. I'm terrible at flipping houses, but someone else that walks in like, oh, this is either just paint, carpet, this thing that's going to cost this much. They just know it so well that the average house flipper makes about $55,000 to $60,000 per house flip because they bring in expertise to that flip. and they can add money and capital and they can turn that flip and make a profit of roughly $60,000 per flip. So there's a lot of different ways to find alpha. Those are just a few little examples to drive home a point that there are a lot of niches that people can make great money if they have access to capital with.
Yep. Yeah. I love it. So this is more of you're here, so I just get to ask you personal questions for my own benefit. One thing that's come up for me, more from like an entrepreneurial background, is why not just start a holding company and then launch my own companies, maybe within, under SPVs, and just raise money for each individual company instead of having a whole fund.
We help a lot of people do that too.
Oh, okay.
Yeah.
So it's just not either or. It's like depending on the situation.
Yeah. I would call that a syndication. So you're syndicating money together for a specific deal or a specific offering. So a lot of our real estate people that come in, we help them, let's do a syndication first, meaning let's just do one deal at a time. So let's pull in hard money lenders or investors. Let's just go take down this property. Let's do a second property and then a third. And then maybe once they've done 2 or 3 or 4, let's do a fund. And instead of buying one at a time, we're going to go buy, we had a guy in our group, he was flipping about 4 houses a year, all syndicating. So he'd syndicate capital, flip a house, syndicate capital, flip. Then we set up a fund with him. The next year, he went and flipped 72 homes the next year.
Okay.
So we help people do that at scale. So we help people do both.
So you can start one way and go to the next one.
Yeah.
Okay. Interesting. What is the most money you've seen be made within your ecosystem, not just the world? And then what's the most that you've seen get lost and why? Like I want to understand the risks and also, the upside.
Inside of our group, I won't share.
Okay.
Because I don't want to have earnings claims and other things against but I'll share you just excess outside. If you look at the largest fund managers in the world, the Forbes 100 list, the number one category of people on the Forbes list is money management, investment funds. Ken Griffin last year made $4.2 billion in a year running his fund by himself. That's one income source. That's not his net worth went up. That's from one income source. He's making $1 billion a quarter. It's stupid. It's the amount of money made in funds it's the most lucrative business opportunity ever invented by mankind. On a percentage basis, fund managers are the wealthiest people on earth. Now, there's people like Elon Musk. We use his net worth goes up and down based on Tesla's stock price. Right? That's not what I'm talking about. I'm not talking about net worth. I'm talking about income generated. The largest fund managers are making $100 million a month, every month, over and over. And it's pretty wild. So anyways, there's a lot of money to be made on the upside. You asked them on the downside, what happens if I lose money or things go bad? Well, 2 things, and I think it's actually important to understand. So what happens, Bridger, if I raise money and I lose it? Number one, if you're gonna raise money from outside investors, it's a serious endeavor. Do not take that lightly. When you're raising money from outside people, there's a whole new level of seriousness that needs to come into your organization. Compliance-wise, team-wise, just attentiveness to detail is massive. That goes across the board. So Bridger, though, what if we start a fund, we raised $50 million and we lose money? Like what, do we all go to jail? Like what happens? So there's 2, if I had my hand up here, there's, I raised money and what happens? There's kind of 2 outcomes. Outcome number 1, or either way, investors or people, they want to know why. Why did we lose money? And there's 2 outcomes from that. Outcome number 1 is we made investments and they just went bad. We made some bad investments. Now they're going to check, were you negligent on those investments? Like what happened? But for example, let's say I was in a venture capital type of business into startups and I put some money in and it went to 0. Well, that's just the nature of venture capital, right? Sometimes things just go to 0. They hired developers, they were hiring coders, and then they launched the business and then a competitor came and just wiped them out. And my investment to 0. And I can live with that. I'm an investor. I can live with that. The other part of this fork, okay, we just lost money in the investment. And it was for all valid reasons. The other side is there was fraud, right? Someone actually stole the money. It was supposed to be invested into this deal, but someone took it and flew to South Africa and has bought a yacht. And you know what I mean? That's different.
Yeah.
And that's where you go to jail. Right?
Yeah.
You were misreporting to investors. You were lying to investors on what was actually happening. That's where you go to jail. You have SEC violations against you, et cetera. So when you lose money, investors or people, they want to know what of the 2 happened. And they'll sometimes do an investigation. They're going to come and look, okay, what happened? Did we invest and just didn't go good? Everyone was honest. Just the investment was a poor investment. That's the nature of investing. Okay, we can live with that. but was there fraud that took place? So that's where you hear on the news, this big fraudster, took off money, blah, blah, blah. And that's why they go to jail. So I think it's good to understand. And I always tell people, if you're not inherently honest as a human, if you have a propensity to lie, you should not listen to this. You should not even consider getting in this game. You will eventually go to jail. It's just not a good game to be in. But if you're someone who is honest, who has integrity, who can break hard news to people. And I always kind of give the example. I say, I don't think most people start out as fraud. Maybe some do start as fraudsters. But like, for example, mom just got cancer. And it's, whatever reason we can't treat her, it's $1 million cancer treatment over in Europe or Asia. And we need $1 million to pay for it, or mom's going to die. Mm-hmm. And you're a fund manager who manages a $100 million fund. And you go, well, what if I just borrow $1 million because I got to save mom, and I'll pay it back. We'll figure it out. We're going to pay it back later. Scenario like that is sometimes what leads people into these fraud cases. They didn't start out as fraudsters, but mom has cancer, something big happens. They embezzle money for a good cause. That's a valuable cause. But if you're going to run a fund, you have to sit there and go, no, that is not my money. That is the fund's money. I know I got to figure out another way. I can't do that. You need to, before you have the money in your hand, distinct that in your brain of where I'm going to be honest with and not. And by the way, we always have people set up checks. There's always checks and balances. And hopefully when you run a fund, you can't even do that even if you wanted to. You'd have third-party auditors and administrators that wouldn't even allow you to do that. But it's a good thought process to go through. That's, I believe, some people that are these big time fraudsters, that's kind of the road. It starts with something actually a good cause. They try to pay it back. They can't pay it back. Then they have to lie. Then they have to be more risky. They got to go to Vegas and gamble money to recoup the money that they lost. And then the whole fund just whittles all the way down to zero. So I'll stop talking, but that's kind of the examples I give.
Yeah, no, that's good. So don't do fraud. All right. I like it.
Be honest. Be honest. And if you're honest, guess what? You're not going to bat 1,000. That's also good to know.
Yeah.
You should try to bat 1,000. Every deal you should try to be a home run. But just the nature of it, not every deal is going to be a home run. Some deals might go bad, but overall, we're going to always be honest. We're always going to tell investors. I always tell investors, I will tell you if we're good, bad, or ugly. I will tell you exactly how we're doing with our fund. I'm not going to sugarcoat it. You will know. You will always get a straight answer from me. If you can live with that, there's some volatility. Sometimes it goes down. Sometimes it goes up. But overall, we believe this is the path we're on. This is where we think we're going. This is why we're entering this market. That's why we believe we have asymmetrical risk. We think this is a good bet. Oh, and by the way, I'm putting a lot of my own money into this deal as well. I'm investing right alongside you are. And we have a third-party administrator and third-party audits to check and have checks and balances to make sure that everything's buttoned up and done the right way. That's how you pitch an investor. And that's what you should be doing.
Yeah, there you go. All right, so with our last couple minutes, I want to go through a few lightning round questions where it's just quick questions, quick answers. Are you ready?
Right.
All right, first one. What is a book that everyone should read?
There's a couple. Launch by Jeff Walker is amazing. Mm-hmm. I've loved Expert Secrets by Russell Brunson. If you're starting out in business, I think those are phenomenal. I'll mention a religious book, the Book of Mormon.
Mm-hmm. That's a good one. Yeah.
I love the Book of Mormon and the Bible. I read both of those a lot. Mm-hmm. Fantastic book, changed my life.
Awesome. Love it. Okay. What is a favorite activity that you do with your kids?
We love boating. We love going on the lake. So surfing, wakeboarding, stuff like that. It's pretty fun.
That's fun. What is one of your biggest 2025 goals, personal goals?
We're going to have a $100 million fund in 2025. So major
that's
goal.
Big.
Yeah, we're excited.
Wow, that's good. What is something you believe that most people might not agree with you on?
I have a lot. I believe this election that's happening in the next 3 weeks is not going to be smooth.
Okay.
At all.
Well, that one's not that contrarian. I feel like just look at the news and
yeah.
What else? Give me something else.
I've been saying this for 5 years. I'm like, the 2024 election is going to be crazy. I believe if Trump wins, Trump will be assassinated. I hope not, but I think they'll be assassinated. Him and JD might be assassinated. Or there's a major disruption, a cyber attacks. I think there's going to be a major disruption in the United States. I hope not. But I've been talking about this for like 4 or 5 years. I'm like, the 2024 election is going to be wild. There's going to be a major disruption. There's going to be, whether cyber attacks or something unprecedented things may happen, may occur. I think we're very close to World War III right now in the Middle East. I could unpack that for a lot of reasons. But those are a few. Sorry, you're getting me down. These are rabbit holes that we're not going to go down. But anyways, I'm a little interesting right now with my brain on this election, and I hope it all turns out fine. I've got food storage, and I think we'll be fine, and we'll do great, and it'll be good. But I think it'll be interesting, very interesting, the next 3 months.
Yeah, where are you located at? So if I need extra food, I'll know where to go.
Salt Lake City, Utah.
All right, great.
So
good to know.
Fun.
What is a secret skill that you have that most people don't know?
I can do this kind of hand whistle thing, but that's not that secret. A lot of people can do that.
Show me. What do you mean? What?
Well, like I can do like these ones, but I can do like multiple hand. I can do this hand or like this way. Anyways, I don't know. I don't have that many great skills, but there's a few.
Right. That's not that cool,
though. A lot of people can do that. I don't know. That's off the cuff.
I didn't even know what you meant. I thought you were just going to do the little like blowing really loud type of thing. So that's actually kind of like, that's like a bird call right there. That's impressive. All right. And the last one, what question or topic are you either afraid to ask or you're afraid to look into? You're like, I don't even want to go there.
There's some things that I'm just not interested in though. Like I haven't gone the rabbit hole of the Buddhist religion before. Like I haven't gone down that rabbit hole, but I don't think
that's a good rabbit hole, by the way. I started going down that recently, and it's actually very good for business. Like,
oh yeah,
seeing, I don't know, it's interesting.
There's like, I'm not like opposed to, I have other things that I'd like to go down first. I actually lived in Taiwan though for 2 years, and I learned a lot about Taoism and Buddhism, and it was very fun.
Well, Bridger, thank you for coming on Mission Daily. We'll definitely have to have you back for round 2. We need more ample time for all my questions, but for now, this was awesome. And where can people find out more about you, your programs, your courses, all of that? If people want to educate themselves on funds, we have a free program all on funds and fund management. So in 2 spots, if you go to fundlaunch.com, we have a free course just on funds. And then we just launched Alt Street, which is completely free as well. So we've interviewed now 6. There's going to be 10 full courses. It's just like Masterclass. We filmed very similar style and content, but it's all on portfolio management, and it's completely for free. So you don't have to pay for it. You can come in. The classes are phenomenal. One of the guys, Mark Malik, he runs a $1.5 billion quant fund, and he just runs through, how do I run a quant fund? Another guy runs like an $800 million private equity fund. All for free. It's our gift back to the universe. And we're pretty excited about it. We just launched a little bit ago. It's been pretty phenomenal. So altstreet.com, ALTST.com is where you'd go. So completely free gifts for you guys. Awesome. Well, thanks for that. And thanks for coming on the show. Thank you, Stephanie.